Hey guys, we're back again with episode number 2 with Sean Yu. What's up, brother?
Number 2.
Yes, sir. We out here dropping grenades. You know what it is. I'm just kidding.
That's a shout out to Brad Lee right there.
Yeah, shout out to my boy Bradley. We want to bring back some more questions, obviously, about the lending side of things. We want to pick your brain. I have a few questions that I've been getting asked throughout the weeks. The number one is how to avoid the PMI.
So mortgage insurance on FHA loans, they are there no matter what. There's certain ways to get out of them, but in the 15 years I've done loans, I've never come across someone that was able to put more money than the 3.5% down and go with FHA financing. So FHA, it's there no matter what. On a conventional loan, the big myth is you have to put 20% down in order to not have mortgage insurance. But if you actually put less than that, and typically it's 10 or 15%, there's ways that the lender can finance the MI, the mortgage insurance, or the borrower can pay for it up front. There's several ways that the lender can structure it. So that's why more often than not, whenever I talk to a client and the first thing that they say when they want to put 20% down is they don't want to pay mortgage insurance. So to me at that point, I know that we can structure their loan with maybe a 10% down option, a 15% down option, and we can show them how we can eliminate the mortgage insurance. And then essentially we're saving them that extra money. I had a client once, he was buying in Chicago that he was a repeat client of mine. So I worked with him over the last few years, but he was like, hey, I want to buy a condo for my daughter as her first place. And I was like, yeah, that's fine. We can get your process going. He goes, I'm going to put 20% down. And I was like, well, why are you going to do that? He was like, oh, because I don't want to pay the MI. I was like, I got you. Let me show you this other way that we can do it, and we'll get you going. Smart guy. He's an investor, but he didn't know about this. So this is before Fannie Mae just made their big changes regarding second home financing. So this is probably like 2-3 years ago. But he put 10% down. So he was going to buy a condo for about $300,000. So instead of him putting $60,000 down, I showed him a way to do it with $30,000 down, and we saved him that extra 30, which he then used that money to furnish the property.
So this was a conventional loan for a second property?
Second home, yep. With 10% down.
Okay.
Yeah.
And if it's an FHA loan, you can never get rid of the PMI?
The only way to get rid of the mortgage insurance on an FHA loan is to refinance out of it into a conventional loan. So one of the important things, if you are buying a house and you are going into and using FHA financing, is to really get with your loan officer and come up with a plan as to how can I get out of the mortgage insurance, so that way you can work on your credit and you can put yourself in a good position, so that way you can almost look at FHA financing as like a temporary loan. So it's 3.5% down. You don't need the 20%, which still a lot of people think that you have to have that today. You can get into a house and over the next few years, build some equity. Like we've seen a lot of our clients that you've sold houses to, we've refinanced and got them into conventional loans. So, because once you get into a house, you're building your credit. So as long as you maintain on-time payments, keeping your debt balances low, your score should go up over time. That now maybe even if, let's say you're at a 660, you got into an FHA loan, maybe in a couple of years, you're over 700. You and your spouse, if there's one, maybe you guys are making more money. So now it's easier to qualify for a conventional loan, get into a conventional loan, and remove the mortgage insurance. So for a lot of people, that's kind of the progression as what they look at with their home financing.
So the benefits of getting rid of your mortgage insurance is you save a couple $100 a month. So that's why it's a hot topic. Everybody wants to save money every single month. So keep in mind, FHA loans, you cannot get rid of it. You have to refinance out. How soon can somebody refinance their home after they purchase with an FHA loan?
If they're trying to remove the mortgage insurance, the biggest thing that we're going to have to look at is your loan to value, so your LTV. So we're going to look at what do you owe on your property, and then what is the property value. So typically when you're removing the mortgage insurance, you want to have as close to the 20% as possible, so that way you don't have to pay the mortgage insurance. So if they just bought an FHA house, 3.5% down, there's really no equity in the property. So maybe in a couple of years, knock on wood, we keep seeing the values go up like we have over the last few years. I mean, 10% appreciation a year, call it a year and a half, you might have the equity there to get out of it.
Exactly. Yeah.
And I think that's an important thing for people to understand, because I think even from your standpoint as an agent, how many times clients will tell you like, I don't want to buy right now, or now's not the time, I'm going to wait. And then they've waited over the last several years and housing prices have gone up. And how many of those clients actually save the money or work on their credit? And can they buy the house that was once maybe 350 that's now 425?
I want to touch on that because I've seen it over and over again. People waited because of the pandemic, right? They were scared. I understand it. But if your job was consistent and you had a full-time hours and you would have gone forward and bought the home, even if it wasn't your dream home, you would have been up over $100,000 in equity. You could have sold that house and pulled all that cash out, put a fat down payment on a bigger, more newer house without money out of pocket, because you're using the equity that you built up on your first home. And this is something that I want to touch bases on, because a lot of people get emotionally attached to the property, how it looks, where it's located. You should be emotionally attached to just becoming a homeowner and start to build equity. And this is very important. And this goes to all the first-time home buyers, because everybody wants to buy that nice house in Summerlin, Henderson, by the park and golf course, but you might not be in that position to do that yet, and it's okay.
Yeah, totally. I think it's definitely something to, like you said, like don't get so attached to the home or the end result. I think knowing that being a homeowner is going to literally give you all these other opportunities that you're probably not thinking about right now. I think that's where a lot of the value comes from. And I mean, you've done it yourself with other rental properties, and even for myself too. And to me, it just starts with that one. You got to get that first one, and everything else becomes so much easier.
Yeah. Dude, my first one was on the west side of town. It was 1989 built, right? Not my dream house, but I bought it. The interest rate I got was like 4.1% at the time, which was great, And now people are freaking out, seeing a 4% interest rate, saying, I'm just going to wait till they go back down. But how likely is it for the interest rates to go back down to 2.5%?
It's very, very slim at this point. The Fed came out, they keep saying they're going to raise rates, and that's the borrowing rate, the short-term Fed funds rate. So mortgage, it's not a direct correlation to the mortgage rate, saying that, if they increase the Fed funds by a quarter, that mortgage rates go up by 0.25%. But one thing that a lot of people just kind of look as a trend, they look at the 10-year bond. So that the 30-year fixed rate mortgage actually kind of follows that. It doesn't do it like directly, but it's a good indicator. I mean, you can actually do a Google search yourself, and you can see, I've seen lots of charts where they actually match the 10-year and then the 30-year fixed rate mortgage, and you can see the trend lines together. So that way you can see how that looks like.
I actually did that this morning, and it's funny because I saw that on Wednesday, the rates dropped a little bit, and then they're climbing back up a little bit again today, back to norm. But it's funny because it's like real time.
Yeah. And that's the thing. Rates change every single day.
Right.
And even I've told clients, when they try to time their purchase or they want to time the market to get the best rate possible, it's almost impossible to do, because you have to be in escrow at the time that the market dips, so that way you can take advantage of the low rate. I mean, we're both in the industry. Even if rates were to be 1% today, unless we're buying a house, we would never get that.
I know. So let me ask you, how long can you lock in a rate once you open up escrow?
So we do have extended rate locks here at Loan Depot. You can actually lock up into a full year. So you can pay, there's a small fee that you have to pay to do that up front, and there are adjustments to the interest rate. So some clients like it because it's more of a secure thing, but a lot of them will take the chance thinking that rates will probably stay the same. Maybe they get a tad worse, but we've seen a lot of people that are buying new builds that are maybe 6 to 9 months out, that they'll take the extended rate lock. That way they can eliminate that worry from knowing that maybe they won't qualify if the rates jump up maybe a quarter or 3/8 of a point.
Exactly. Yeah. Another topic I wanted to touch on is the forbearance. A lot of people are coming out of forbearance. They're asking if they can sell their house now. What happens to the loan? If somebody got put through that process of forbearance, can they sell their property right after it's over?
Yeah, they can sell at any time. I think it's very, very important to make sure that if you signed any paperwork throughout the forbearance period, agreeing to anything, you really understand what you signed. Because when the forbearance, first came about during COVID, I think a lot of people weren't really familiar with what they were signing, which takes me back to the foreclosure days and the short sale days that no one knew what they were signing and they just went along with the banks, or they were doing loan modifications. Because I've had clients that they said, well, I reached out to my bank, I told them I needed a forbearance, and they were under the impression that, I never had to pay this money back. I was like, no, you still have to pay it back. They're just throwing it to the back of the loan. Then it was, well, are you making payments for a shorter period of time to then repay the bank? So I think it's important that you look at what you signed or what you agreed to, because everyone's situation is going to be a little different. But if they wanted to sell, they could do that. But just remember, if you didn't pay $20,000 or $30,000 worth of mortgage payments, the bank's going to want their money back.
Yeah. So if somebody is in forbearance and they have no idea what they signed, can they reach out to us? Can you review that?
Yeah. If they have their paperwork, we're always happy to look at it, just so that way we can kind of dissect what we think it is and at least give them some guidance, and then they can always contact the servicer directly, at least with a few points or things of reference that we can guide them on.
Because I would probably just call you, bro. Hey, check this out. I'm not sure what happened.
Yeah,
what are we doing?
And I've done that for clients, because I hear these horror stories of people that, they were even reaching out and saying just to get information, and the banks were actually throwing them into forbearance. And there was one client I remember that they actually reported him late on his credit report. And he was like, well, how am I late? I'm in forbearance. I'm like, well, you look at your credit report, and the bank actually reported him late, which hurt his score. So we gave him the credit report so he could go back to his bank and kind of fight that with them. So, it's unfortunate that sometimes I think the banks, the right hand doesn't always talk to the left. And again, we've seen that during the short sale days, the foreclosure days. It's unfortunate, and sometimes customers have to go through that, which is not fair, but that's why we do these videos. We want to make sure we help as many people as we can.
Yeah, definitely. And for all of you that are new to this channel and new to Sean is ranked 1% nationwide in home loans and lenders. And I think that's what makes you up there, because you go above and beyond and check forbearance documents and things like that. What else do you think that you do that makes you stand out and puts you at the top?
I love what I do. I've been doing this for over 15 years. And I remember the foreclosure days and people losing their house. I was 22 years old at the time, and I didn't know what was going on in the world. But I remember those days very vividly of, husbands and wives that would come in, and I could see them like literally wanting to tear each other's heads off because, of their finances. So I think going through that helped me really understand of how I want to help people going forward, and just knowing that the home buying process, it is scary. It is, terrifying, and you have all these emotions from being happy to anxious to fearful. That, are you doing the right decision? Are you making the right decision? And even when I bought my first house, even being in the business, you still ask yourself those questions. So even for us, it was doing the right thing for the client. And then it evolved to doing some content, because how can we help more people understand what we've learned over the years to give them all the right information, because there's so much bad information out there. So the only way I felt for us to make a contribution, we kind of have to do it ourselves. And obviously you and I have been working together for the last few years, and I love everything that you do and how you fight for your clients, because there's not a lot of realtors out there that do that. They say they do, but do they really?
Yeah, no, I've heard a lot of bad stories, and I've had a lot of people come to me while they were already in escrow with an agent they hated. And once you open up escrow, it's really hard to get you out of that deal. So I always emphasize, talk to a few realtors, get a few recommendations from other people that already worked with him in the past. That way you can have a better experience, and the process is going to be a lot easier, because if you don't trust your realtor, you're going to question everything he says, and it's going to be a horrible time for everybody.
Same with the lender. And I think the way that the consumer is conditioned to shop is to literally be for a realtor. Maybe they're seeing who's the cheapest, who's going to answer my call, maybe the fastest. And sometimes a good agent might not get back to you immediately, because they may be doing content, or maybe they're in a meeting, So I think you have to give them grace in that sense. Or maybe they have a team and kind of figuring out what their structure is. And I think it's also important that you look them up online, like you said, because there's so much that goes on during a transaction that, there's a lot of questions that sometimes when we deal with real estate agents all across the country, they're asking me questions that if the client knew what they were asking, I think the client would fire them. So it almost terrifies me in a way to know, like, man, I need to try to help this client out without, making the realtor look bad. We always want them to, I don't want them to lose the deal, but at the same time, I want to make sure that client is protected.
No, 100%. And I wanna touch back on what you said earlier about making a purchase, right? Making this investment. It's always gonna be scary, even if the market is lined up perfectly. The interest rate is bomb, everything is perfect. It's still gonna be a scary situation. So that's why I always tell people, be committed to your goal of being a homeowner and not be committed to finding the perfect house, because that house does not exist. Even if you were to build it from the ground up, 6 months later, you would have wished you would have done something different.
Yeah. And we know that by renovating, your own house, you're probably like, man, if I could have done my shower a little differently, I would have picked a different tile. There's so many things. And I'm glad you said that, because I always tell the story of, if you go back and you look at the real estate market back in 2011 here in Las Vegas, that was kind of the bottom of the market. The media, all they said was, Las Vegas was the foreclosure capital of the world. It was us, Florida, and California. And if you were a first-time home buyer, that could have terrified you enough to not buy, because you could have looked at that and said, well, the media is saying don't buy, or, there's all these foreclosures that are happening, and maybe you think that's going to happen to you. But when you kind of zoom out and you look at the last 20 years, you're going to see that home prices were, I think the median price during the boom was kind of where we are today, 380 to 400. And then where was it back then? It was in the low 100s, like 150s. Yeah. But when you look at that, now you would buy. So was that the best time or the perfect market? No, because a lot of people were saying don't buy at that time.
So I think what made a difference for me, because I bought my first home in 2009, 2010, and I didn't know if the market was going to keep going down or start going up. But what helped me is being partnered up with a good agent that understood the market and that had the best interest in mind for me. Yeah. So that made all the difference for me. I got the property. I bought it for $94,000.
What was your mortgage payment?
$605.
Insane.
With a 4% interest rate. I got it appraised last month, and it's at $350 right now. So if I would have been so scared of the market and wanted to time it, I would have missed out on a great opportunity, 100%. So getting partnered up with the right agent is going to be key, you guys. And make sure that he's reputable, understands the market, and has your best interest in mind. If he checks those marks, I think you'll have a solid realtor.
And I think another key piece is having an open line of communication. I think a lot of people look at real estate agents and loan officers as, yes, we sell in a way, we're salesmen, but if you don't tell your agent what your goals are, or if they're not asking you, I think that's also a problem, because you want to be able to express yourself and say, this is maybe what's held me back in the past, and these are some of my fears I need to get over today for me to feel comfortable about buying. And I don't think that conversation happens a lot. And I think that's why a lot of people feel apprehensive about talking to loan officers or realtors, because they think that, hey, they're just trying to throw me into a house. But I think for us, why, we've done so well with a lot of our clients is that we try to figure out, like, how do we help these guys first? And you know what? Maybe you're not ready right now. You got to work on a few things, and hey, in 90 days, maybe then you'll be ready to buy. So I think for, having that open line of communication to be able to express yourself and to know that, like you said, they have your back and they're going to do the right thing, then to me, again, the stars align, then the process should feel a lot more comfortable than, having that regret after you buy and you're like, shoot, I should have never bought this house.
So our process is, we meet with the person that wants to buy. We do a buyer consultation, see what kind of property they're looking in, see what's important to them. And then even after we get them pre-approved and we start showing them houses, I always have them rate the property from 1 to 10, 10 being the best. So just by their rating, they're going to tell me everything, because sometimes people are super nice and they don't want to make me feel bad that they hate the house and it looks like shit, So I'd rather them tell me, you know what? I give this one like a 4. Oh, okay, perfect. We go to the next one. This was about a 7. So I'm already gauging what they're liking, what they're not liking. And I make the process just easier on them and on myself too. And that way we can always get somebody into a nice property that I know that they're really liked right away, almost within a week or two.
Yeah, you do a really good job of that. And I think that's just because you know the market, and I think your process. What 3 things, when a client comes to you to do a consultation, that they should maybe be ready to talk about, or maybe know how to answer the question? What are the 3 things that you would tell them?
So the first of all, do you know where your credit is at, right? Have you done the last 2 years of your taxes? And have you been working full time in the last year or so? So I want to make sure that their employment history is good and that their credit is good enough. I don't even focus on how much money they have saved yet, because we could always work around that.
There's ways to get around that. Exactly.
So for me, credit is important, and work history, and that you have filed the last 2 years of your taxes. From there on, we can help you and arrange a way where we can get you into a property. So that's the basics, I wanted to ask you too, because I get this question almost every day. People DM me on Instagram. By the way, if you guys have any questions, follow me on Instagram, shoot me a DM. I know that sometimes you have questions, but you're not ready to talk to an agent right away. A DM is an easy way for us to interact and just to get basic questions answered. The question is, how much do I need to make every year to qualify for a house?
So there is never a minimum or a maximum. We're just going to go off of what the client is earning. So we look at the last 2 years of their tax returns. We're going to look at 1 month of current pay stubs, because that's going to give us a trend as to what they've earned, what they are currently earning. Are they on pace to make the same amount of money? Or are they making less? So think of going to the lender as like going to your doctor. If you're feeling sick, the doctor has to diagnose you. The nurse has to check you out. And that's kind of what our role is as a lender. We're trying to figure out, based on the income that you're showing us, this is what you could potentially buy. Now, if it doesn't work for your budget, let's just say we qualified you for a $400,000 house and you're looking for $500,000. Okay, there's ways to get there. Now we know what facts that we're dealing with as far as your credit, your income, and your debt. Now we can make recommendations to say, either we have to come in with more money, maybe you need to pay off some debt, or do you have a cosigner that can help you get into the property? So there's always a way to figure out how to get somebody into a house. It's just going to be, is the client going to want to put in the work? Or is the client capable of doing some of the tasks in order for them to get there?
Yeah. So with that being said, I made a video a long time ago about this, but I want to do it again because I've seen it a few times where I have friends or family that are hesitant to work with me because they don't want me to find out their finances. So we're not licensed to look into your loan. That's why we partner up with great lenders that know the business, and that's all they do is look into the finances and structure your loan. As a realtor, we have nothing to do with that. So we really don't know your debts, your income, anything like that. All we know is that you got pre-approved, and here's a approval letter, and here's a purchase price, and now I can get to work. So if you have a friend of the family or someone that's a realtor and you're hesitant to work with them because you don't want them to know your debts and finances, you'll be okay because he's not going to know. The lenders are the ones that dig in there and get all the details and all that stuff. So I wanted to make it very clear.
Yeah, and I think, to piggyback off of that, sometimes people are a little fearful or, are you going to look at what I spend money on? We really don't look at what you're buying. Honestly, we don't really care. What we're more concerned about is the deposits. Are the deposits verifiable? That's the one thing any lender will look at. So don't feel that, we're going to be invasive. And yes, some of the documents and the amount of stuff that sometimes are asked can feel that way. But the number one goal of what we're trying to accomplish is to make sure that we can get you into a house. So whether you're on Social Security or fixed income, a pension, as long as we can verify the income, we can use that to qualify. So it doesn't matter how little, how much. Back in the day when homes were really, really cheap, people on Social Security making $2,000 a month were able to buy a house. So we just got to figure out what you're currently making, and then we can determine how much or how little house you can buy.
Yeah, because somebody could be making $10,000 a month, but if they have $6,000 in bills and cars and truck payments, they're gonna be out the game.
You're not buying a house, and that's why too. I always tell people that because sometimes they'll say, "Well, what credit score do I need to buy?" Well, the credit's part of the process. We still have to look at your income, your debt, how much money you have, because you could have let's say a 750 credit score, but your DTI is 60%.
I remember we qualified a client that was under a 580 credit score. He just had to come out of pocket a little bit more for the down payment. We got him into a house, done deal.
Exactly. So that's why, depending on the lender, it's always worth having that conversation because guidelines change all the time.
Yeah.
So you never know what you're going to deal with, which is tough for the consumer. And again, if it's not your realtor's job to know that information, it's your realtor's job to have a good lending partner to say, hey, go talk to this guy. They're going to walk you through the process because we got to, that client could have looked at his credit and been like, I'll never buy a house. Yeah. But you're like, nope, let's talk to our team. And hey, sure enough, you were under a 580. There's probably lots of banks out there that will tell you no, but we found a way to make it work, and now he's a homeowner.
Definitely. I wanted to ask you, how can someone calculate closing costs on a purchase price? I typically always use 2% rule of the purchase price. So when somebody asks me, as a first-time home buyer, how much money do I need out of pocket to buy, I always take the 3.5% down payment plus 2%. So I have them do the purchase price minus 5.5%, and then you'll have a rough estimate of how much cash you're gonna need out of pocket.
Yeah, that's a good ballpark. I think if you're buying anything under, let's say, $300,000, that could easily be 3%, because obviously percentage-wise, some of the costs that go along with that are closing costs are fixed. They'll never change, right? Like a mortgage lender. Like for us, we charge $13.95 our processing and underwriting fees, and that's regardless. That doesn't matter if the loan's $60,000 or if the loan's $2 million. So the percentage of some of the fixed costs could weigh higher on smaller loan amounts, and vice versa. So you buy a $2 million home, $13.95, it's nothing. It's not even a percent. So it just depends. But yeah, that's a good ballpark for them just to kind of get a rough idea of where they stand.
Yeah.
Now, let me ask you this, because I think this is something that not a lot of people know. Are closing costs negotiable?
Technically, yes, but in this market is highly unlikely. You know, we're competing with 15 offers, sometimes 25 offers, and 6 of them are cash offers, which means that they're not going to ask the seller for anything. They're giving them straight cash. They don't even need an appraisal done. They can close in 10 days. So for us to compete against them, we cannot ask for the seller to take out money out of his pocket to give to you to sell the house to you. You know, they want to get the highest and best offer that's going to make them the most amount of money. So 3 years ago, yeah, we can ask for closing costs, no problem. But now it's a different type of market, and it doesn't mean that you shouldn't buy. Or I've had people say like, I'm not going to buy because I'm not going to overpay for the house because it's only appraised at 350, but the seller wants me to come out of pocket another 10,000 to buy the house, and they don't end up buying. Yeah. And what happens is that 6 months down the road, if he would have paid 360 for the house, it would have been worth close to 400,000 now. So the extra 10K, it would have been a great investment for you to make an extra 60,000 in a couple months.
I think another hack out there is that your lender can actually help cover your closing costs. So how that basically works is, as a mortgage lender, we will always give the client the best rate possible. There's no incentive for any lender to give you a higher rate like we were back in the day. Back in the day, before the Dodd-Frank and all that stuff happened, the higher the rate that the lender charged you, the more money they made. So now what they've done to help protect consumers is, if we were to charge a higher interest rate, that overage, that let's just say that would have made me my commissions, go automatically back to the client. So let's just say the interest rate today is 4.25. We could actually give a client 4.5, and I might be able to give them maybe $2,000 of credit towards their closing costs. Okay. So that's where, again, having a good lender that's knowledgeable and knows how to structure deals can help somebody. So you don't always have to have a ton of money in the bank. You can still talk to a lender up front, get a game plan together. And again, like I said, it might take you 3 months, 6 months. I've had clients that we've called over a year or two that they ended up buying eventually. So sometimes it just takes a little bit of time.
Yeah, I've heard that before, that the lender can cover the closing costs, but I thought it was just like a hook or something to get people to give them a call. Yeah. And it wasn't really true, but you can make it happen.
Yeah, we can certainly do it. And that's typically what we do when we look at our pre-approvals with our clients. You know, I talk about this even on my YouTube channel a lot. It's, you have to look at options. When you just base your decision purely on interest rate, that's not always the best deal for you, because any lender can give you a really low rate, but there's going to be additional fees that come along with that. It's like one of those asterisks that, you know, at the end of a statement, you don't really look into it, but you got to read the fine print. Mm-hmm. And until you know that what you're getting into, it's hard to make that decision. But unfortunately, a lot of people, when they shop for a mortgage lender, all they care about is what's the interest rate.
Yeah, no, definitely. And you guys can find Sean on YouTube and on Instagram. And if you're going to reach out to ask him any questions, make sure that you heard it from here. Vegas Carlos podcast, dropping grenades all day, just so he knows that you came from our channel and we want to show him our support so he can help you in the best way possible to get you a home. And keep in mind, he's also licensed in different states, not just Nevada, so he can help anybody out. That's why I like working with Sean. He's a great asset to the business. He's a great partner, and he has the information right when it comes out. Guidelines change, and Sean's always on top of it, shooting out the new information. So feel free to reach out to him with any questions you may have.
Don't be afraid. We know the buying process can be difficult, but this is honestly why we do these types of videos, because we really want to help you get over that fear and become a homeowner. And so that way you can start building that wealth and seeing some of the benefits that we've personally had ourselves.
Yeah, definitely. Well, thank you so much, bro, stopping by.
Alrighty.
And I'll see you guys on the next one.